In this episode, I had the pleasure of speaking to Ted Oakley. Ted is a true investing expert with over 40 years of experience working with high net worth clients. You can learn a lot from someone who's been through so many decades of investing. I learned so much from Ted, and he has some great wisdom to share in this episode. In our conversation, we cover Ted's remarkable story of growing up in a home with zero money, no running water, and what helped him achieve financial success despite all of that. We discuss the top mistakes he sees investors making, how people's past experiences with investing can cause them to make poor decisions, and what to do about it, of course. Also, the importance of diversification and limiting exposure to any one specific investment. And we also discuss Ted's market outlook. All right, let's dive right in. Hello, Vision Nation. In this episode, we have the privilege of learning from Mr. J. Ted Oakley. He is managing partner and founder at Oxbow Advisors, headquartered in Austin, Texas. Ted, it is a pleasure speaking with you. Welcome to the show.
Thanks, Vlad. Good to visit with you.
Now, I want to start by saying I finished reading your latest book this week, and the book is called Stay Rich with a Balanced Portfolio. It was a great read. I love how you kept things simple and to the point. It's a book that a novice or experienced investor can pick up and get real actionable value out of it. I highly recommend it. Now, I want to get into the concepts that you wrote about in the book, but first, you have a very interesting story yourself. And Ted, could you please share your experiences growing up in an environment with limited financial resources and how you transitioned from that to building a hugely successful investment firm?
Well, Vlad, I don't think I'm necessarily too unusual in this. A lot of people grow up, with really tough backgrounds. Mine was on the North Carolina Georgia border, where we were basically hillbillies. I mean, we didn't have indoor plumbing. We had an outhouse, and we didn't have running water. We had a water well on the back porch, and really no money at all. Never did have any money. I just happened to be in an unfortunate situation where my father was a Pentecostal minister, and he just couldn't, he didn't see the benefit of education, and there's a lot of things go into it. And that's not a disparaging remark. It just wasn't for me. I got a job when I was 6 years old just because I didn't have any money, and I was a little guy running around, but I always had a job, but even until today. And so what transpired from that was really, and I think so much today with entrepreneurs grew up the same way. They really want to get on the other side of the ledger if possible. And I think that's what drives a lot of people. They just want to continue to achieve. And I was always an achiever, still am, but not unusual. I mean, I meet a lot of people that had really rough backgrounds, rougher than mine. I have a lot of foster kids in my foundations, and oh gosh, they have it much worse than I ever had it. But, you have to be resilient. And I think that's what people need today. They need resilience.
hmm hmm It's an amazing story, and I agree with you that it does. You do hear of other people being able to turn their life around so drastically as well, but you also hear of the opposite where people are not able to do it. So it's really a testament. And it's amazing to hear your story and what you've able to do. So I wanted to ask you, were there some specific strategies or kind of mental models that you used that really helped you transition from not having financial means to being very financially successful?
Well, one of the things was I really was always a believer in no debt. Now I had to work I worked 4 hours a week going to college. I got my degree before I went to New York City. I was lucky along the way. A lot of people helped me, but I think one of the things was not having any overhanging debt. Was a big thing. Did I want to have things that other people had? Yeah, probably, but I couldn't afford it, so I didn't take on the debt. Today's kids have a lot of debt in school, and they didn't have that then. You had to work to go to college. So that started it that way. And then the other side of that is I knew how to, in the early stages before you have any money, you have to conserve the money you have. You can't be reckless with it. And I think that probably always driven my investment philosophy today, which is preservation of capital, and that's really what's probably formed that as much as anything.
That makes a lot of sense. Based on kind of the success stories that I've read about as well, being conservative in a lot of cases has been really beneficial to people. Of course, you hear about people that take excessive risk and they kind of get lucky too, but I don't think that's a really replicatable strategy in most cases. Now, shifting gears a little bit, what would you say are some of the top mistakes that you often see investors making? And what are some actionable steps that you recommend for them to take to avoid making these mistakes?
Well, the biggest thing, Glenn, and if you look back over 75 or 100 years ago, there were numerous millionaires. It should have been billionaire families today, a lot of them. And you look at the Ford's 400, every 10 years it's a different group of people. Not always, not entirely, but a lot. And one of the things I found with people is when I say balance, they either make too large of a bet or they take too small of a bet. By that I mean when they're investing in things that have risk reward return, okay, that should be higher than the norm, they either overbuy, they put too much into something, or they don't put enough. I've had really conservative people that should be balancing to have a little bit, they should have more on the growth side, whatever that might be, whether it's private business or oil and gas or whatever they're comfortable with, real estate, but they don't. And I think that's just as bad. That's what's happened to a lot of wealthy families over the years. And that's why they didn't maintain it through two or three generations, in addition to the fact that they spend too much money. But the main point is that when I say balance, I mean people they don't think about it, but all you need is a couple of setbacks, and you're out of the game, so to speak. Or you don't do anything for 10 or 12 years except look at your money and feel it every day, and you're out of the game too because inflation killed you. So that's what I say when I say balance. That's what I'm talking about. They need to understand the balance, but you need to understand yourself also, because if if you just want to buy an index fund and you're okay on the up years, but when you have a down market that takes you down 30, 40, 50%, if that just ruins you emotionally and you blow out of it, well, you didn't do yourself any good. In other words, you didn't know yourself well enough to know what balance you needed. And I see that a lot as well today, in the same vein.
And one of the parts of the book that I really enjoyed reading about was when you were talking about how people's past experiences can affect their thinking and how that can impact their investment decisions. Can you tell us a little bit more about this concept?
Well, I've done a lot of work with people that are first generation wealth, that made a lot of money, and a lot of those, some of those, they grew up with nothing too. So they're very, very protective, so protective that they don't understand how to take any risk really at all. I think that's unfortunate, but they should be able to. And the other side, where they do really well, but they came from a family that had plenty of money and they never thought about spending money, so they spend too much of it, and so their background has a lot to do with it, and when they were in the marketplace. If you look at people that were born, say after, got out of high school, say after 1985, they had 15 years of really great market up to the time, they were, mid 30s. So that influenced their process of what they thought about, over the next 10 or 15 years of investing. Similar to grandparents, where they were kids during the Depression, they never owned a stock and never were going to own a stock. So it depends on when you came into what you take a millennial, that came out of high school in 1999, 2000. They've had it rough because they've had three or four really tough periods, and I think to a degree it's made them really not trust the marketplace, which is understandable. But it has to do with when you're born and the timeline. A lot of that goes into what happens.
And the other thing you were talking about in the book as well was where you mentioned somebody who grew up in the Great Depression as an extreme example. Those people would have a hard time investing in equities, and they felt like equities were very, very risky. Whereas by staying away from equities, they were taking on additional risk in terms of not being able to keep up with inflation, for example.
Well, it's true. I mean, I don't have many of those people today because most of them are deceased that were children in the Depression. They would have been, well over 95 now. But I had a number of them over the years when I was younger, and they want it was nothing but CDs or treasuries. I mean, they wouldn't even fathom something else. And if they did have any stock, they had the certificate in the lockbox at the bank, at the safety deposit box. They didn't even trust the firms. So yeah, I've been through that with a lot of these people, and they were most of them were like that. I have to say, most of them had that mindset.
And you also mentioned that when you were younger, you had more of a conservative investing style. This was earlier in your career, and I assume that you were probably investing in only the safest types of securities that yielded pretty low returns. And I'm also assuming that later on in your career, you probably started investing more in riskier, but intelligently riskier asset classes like equities, for example. How did you overcome that bias?
Vlad, that's a really good question because I'll tell you, when you have a bias that's emotional and a psychological bias, and everybody has them one way or the other, it's like coaching a football team or a baseball team. You have to determine what errors you made and how you correct those in the next game, okay, as a coach. And for me personally, what happened is I was too conservative because I was putting together that net worth at the time, I was real younger, adding money in. And I realized that I carried this over into philosophy of the firm too, that what I needed to do was have what I call base capital, an account that was base capital that didn't move around at all. It was really short term, high grade, nothing but CDs, treasuries, that sort of thing, because I needed some money to know that it was always there. And then on the other side, I could have my investment capital and then I could trust it. If it moved up or down, I was okay because I didn't have the two together. In other words, I had this piece over here, and that was my emotional stability piece. And then I had the investment side, which included for me, private businesses, oil and gas, royalties, all sorts of things that we did, real estate, um, and I'm invested in a bank, community bank. But that was the difference really for me. I had to develop those two pots, and we carried that over into the firm. We still have a concept today called base capital, investment capital, and with people, we try to tell them, don't confuse the two. Don't put them in the same account. Okay, they're different kind of money, and that's how I got through it.
Hmm. And I'm just curious how you structure that. So, do you actually keep separate accounts where one will be a base account and one will be more of an investment account? And that kind of helps mentally to separate those two out? Is that right?
Well, I don't have to look at the base account too much. I'll tell you why, because everything in there is less than 18 months as far as CDs, treasuries, maybe really, really high grade municipals, but generally it's the two things that are fully guaranteed. Now, a lot of people say that's too much. Well, maybe so, but what happens is when you get into times that are really, really volatile, and you don't have to look at that account, okay, because it's okay, then it allows you not to have to concentrate so much on the ups and downs. I tell people all the time that don't do this. They have everything pooled together, and I see them doing this all the time. They go online, they look at their account every single day, and really they stay in this they stay in this complete upheaval all the time. I mean,
Mm.
it's like if it's up one day, they're feeling better that day. Next day, it's down. If you go down 7 or 8 days in a row, they're like, oh my God, I don't know what I'm going to do. And like I mentioned to them, you have your money structured wrong. You got to have money over here that's what I call base capital. In other words, it's that's what you live to play another day on. Okay, so you never have to worry about if we have a 50% drawdown like we did in 2000 or 2008. You're okay, and you
Hmm.
have the ability too to decide. Well, do I want to maybe use some leverage, or do I want to put more money? What do I want to do? Emotionally, I'm okay,
Hmm.
and that's what we try to get people to do.
It's so important to get the emotional aspect of investing really under control. It's not just the pure logical nuts and bolts. And I've seen some very, very experienced investors that have had decades of experience in the market. And when times were rough, during COVID, for example, they really made some irrational decisions. And it was very enlightening for me to see that. It was eye opening because if you don't keep the emotional piece in check, the strategy is not really going to work.
Well, that actually is the biggest thing. If you uh, follow Warren Buffett or Charlie Munger, you'll find that the emotional approach to investing is the number one thing. I mean, if you can control your emotions, it's fine. Give you a good example. During COVID, oil went to almost zero. We made one of the best purchases we ever made, which was in an oil royalty company that, believe it or not, the private equity that owned a big piece of this public company decided that we don't want to be in oil when it was like $5 a barrel. And I'm like, you got to be kidding me.
Hmm.
You're assuming we're not going to be driving and we're not going to be, I mean, they have no concept of what was going on. So that ended up being a 4-to-1 company for us. But you have to have your emotions in check because if you buy it, it's probably in those kinds of times, it's probably going to go a little lower on you. And you have to realize that, you know what, long run, 2 years, 3 years, this will be a great, great investment. But it's all in the emotion. You got to take emotions out of it.
Mm-hmm, mm-hmm. Well, yeah, easier said than done, but that's
Yeah.
what people should aim for. And
Well,
now,
if you have, if I know exactly what you're saying, but it's easier said than done, and it is. But if you have that pool of money I talked about, you're okay. You
oh
you
yeah,
you'd be surprised how that would settle somebody down. We've used it many many years now, and it works when we do it that way because you go in a real bad market and you're having a meeting with somebody, and yes, the stock account's down some,
mm.
but your other account is just fine.
Oh yeah, that's
So
just
you talk about beating the market. Well, that's beating the market. If you want to look at it that way, that the other side of it is, there's times when I say balance. There's a piece in that book called "There's a Few Times to Be Unbalanced," and that's when I like to rant. Right now we're unbalanced for us. Okay,
mm.
we're like 55% liquid
Mm.
treasuries and a stock account. Okay, has that done well for us? Yeah, because if you look at the last 2 years, we're doing fine. But people would look at that and say, well, that's not too great. Well, we couldn't find the companies though. See, so it depends on where you are and what's happening. But there's certain times for everything.
Oh yeah, and let's say so. Just as a scenario, let's say someone just got a big inheritance or sold their business. A lot of times, people will go on a bit of a spending spree, and from your experience and what you wrote about in the book, that type of thing often doesn't really lead to happiness. Why is that, and what can people do to counteract this desire to spend too much?
Well, it's like one of the best books I've read in the last couple of years is by a guy named Michael Singer called "Living Untethered," and it's pretty deep. But what point make is that for you to be happy in life, you're not going to be happy with things, okay? And so a lot of people, and I would classify those two groups that you just mentioned in two different categories. We would deal with an inherited wealth person much differently than we would be a business owner that sold. We do a lot of business owner sales, so we know how they think and have written a lot about it over the years, but they're different. And business owners, when they sell and have that big money, see, they're used to winning on everything. They've just won. They built this company, sold it for $40 million, and you know what? They didn't have anything, and so obviously they're used to winning, and they think they can win at everything. Now they can't, by the way, but they think they can, and so that's one of the biggest mistakes they make. And think, I'll buy this, I'll do that, I'll invest in these two companies because I know I'm really good. Well, they really were good at what they did. Okay, no question about that, but that did not give them the license to say I'm good at everything else. And that's different from inherited wealth. An inherited wealth person fall in two categories for us. Either they cling to the money so tight that they talk to 30 people to try, they get too much input, okay, because they want to be right. They didn't make the money, so they feel like that I could lose the money, Okay. And
Mm-hmm.
that's a different kind of person. Or they've inherited the wealth and they spend like crazy. They grew up in an atmosphere where their matriarch or patriarch had a lot of money,
Mm-hmm.
and they grew up spending a lot of money as a kid. Okay. I mean, on everything you could think of, always flew private, you name it.
Yeah.
Now they have money. They try to do the same things with it, and see, it backfires on them because they don't know how to make money. They just received it. And so
Mm.
you have to spend a little bit different time with them than you would, say, a business owner.
Yeah, it's a very different frame of mind. I want to talk a little bit about your firm as well. So, Oxbow Advisors follows a unique philosophy in terms of investing style. You invest in companies with predictable cash flows and strong business moats. And that really differs from the sort of high growth, unprofitable company investing approach that you see some other people doing out there. Now, could you explain why you invest the way you invest?
Well, you'll find over time that cash flow is everything. I think any good business person will tell you that cash flow is everything, whether it's real estate, oil and gas, private business, whatever, or stocks themselves. And so we look for high cash flow companies that have a lot of free cash flow, okay, low debt. Because what happens is, well, you'll find if you go back and look at companies over long periods of history that have inordinate debt, too much, they never do as well. Look at Warren Buffett. He probably never paid more than 15 times for a company. And I'm talking about multiple. And yet you see all these people buying, unlimited multiple on companies that make no money, companies that are unicorns, all this sort of stuff. I've seen it all, really, if you want to know the truth. I knew they would just end up horribly because it's a joke, the way they put them together. All of that sort of stuff is not real. And so it all comes back to cash flow. And you'll find that over time, if somebody can buy a really good business with really good cash flow, debt is in line or small. If they can hold that company long enough, they will make money in it, but they got to stay with it.
Yeah, you almost want to have the ability to invest in companies that will do well in any sort of environment. Some companies can do really well when interest rates are zero, but if interest rates go up to 5%, all of a sudden it's a whole different ball game. And so being able to choose companies that are in it for the long haul that can withstand any sort of shocks is really a great long-term strategy, I'd say.
You have to remember too, if you look at Google and Facebook and Microsoft, people don't realize this, but when they went public, they were making money. Okay. I think people forget about things like that, and they don't realize that what needs to be, and then they don't realize they have a company that's done really well. I saw John Chambers on television yesterday, and I got to think about Cisco, but I was the the thing about it is that at certain times these companies are never going to be what they were, and you pay too much for them. And I'm certain that some of the big 20 companies that are just been really bid up a lot will never be that high again. I'm not saying which ones. I'm just saying that happens in every cycle. And I have people that make this statement, which is unfortunate, by the way, that I will never sell X. Okay, and that's a mistake. I'll put it that way.
Mhm. It makes total sense. Sometimes people have almost an emotional attachment to an investment. Let's say if they do really well with it, it might be, a 10 bagger or something. It kind of, I feel like at that point, logic leaves the room more or less. And then it's not so much about logically looking at, okay, what are the cash flows? How's this business? What are the future prospects? It then becomes more of a, well, this investment was great for me in the past.
Well, and they get confused. And I'll give you some examples. If you look at people that owned the drugs, for example, in the 80s, they made a lot of money. I mean, I can show you. And what happened by the time they got into the late 90s, they had made so much money that the number one thing they would say to me is, I can't sell that because I don't want to pay the tax, which that's not a very bright reason not to sell, by the way, because you want to pay as much tax as you can eventually. But what would happen is they didn't sell anything. So what happened is it took them. You had to go 20 years, 25 years before they ever got back to those prices. And they forget that, yeah, you had a lot of profit, but you just gave up 20 or 25 years worth of inflation. So you really don't have that much profit. And you should have sold something, gone another direction, and everything changes. Same way with, the big tech companies of the late '90s. You look at Sony and Cisco and Yahoo and Time Warner when they bought AOL, all that stuff. They never came back. They still not back, today. And people are just, I remember a fellow told me, an elderly gentleman told me about 1985. He said, yeah, I'll never sell Coca-Cola because it will never not make money. Well, guess what? It went about 25 or 30 years and didn't go up in price. It's actually pretty decent price now, but that's the kind of thing you run into, okay? That's what I'm saying on the emotional side.
And one of the things that you talked about in the book was the importance for investors to really dig deep and understand how they handled previous financial crises. Why do you think that's really important for people to do?
Well, I think the biggest thing with it, Vlad, is that people need to understand if I've gone through two or three these big sell-offs, and every time I go through this thing, I'm so discombobulated that I almost get a divorce. My kids hate me. I mean, I lose it. I lose every bit of common sense that I had. Then I need to rethink how much I've got exposed to equity. Forget about the fact that I can't make as much as everybody else can. I got to live with myself, all right? And there's people out there that we know, a lot of them that we invest for that are just bulletproof, but they have a lot of real estate. Okay, that's where they take their risks. That's okay. I have no problem with that. I think you just have to know who you are, and know because people don't trust the stock market as much as they do real estate. I can give you all the studies on it, but they don't because they can go down and kick the real estate and touch it, and see somebody walking in on their stocks. They're just a one liner in the Wall Street Journal, so they don't emotionally. People, if you're like that, you need to really think about it. And the other side of it is if emotionally if every time you have a really big bull market, you jump in and buy the meme stocks and everything else everybody's buying at these ridiculous prices, you need to ask yourself, okay, I lost money on a lot. I've done that two or three times now. Um, and I've seen it over and over again. I mean, I've had, I had a group leave me. I've had people leave me because we don't get aggressive enough when markets are high. But I had a guy leave me in the late '90s. He got wiped out. He came back to us and we were doing steady investing for him. Well, he couldn't take it and he did it again. And believe it or not, he got wiped out again in '08. And I never heard
Oh
from him
no.
again. But that's the kind of thing you have to ask yourself, what am I made of here? What makes me go in market highs and get all excited? And is it an ego thing, or if I'm at a cocktail party, somebody tell me how well they're doing? You got to blow all that stuff off. Well, most of the time, they're lying to you anyway. But you need to go on and you need to go and think about how do I handle investing emotionally? Let's go negative. Let's go positive. And once you figure yourself out, I wrote a little book called Your Money Mentality. That's a good book on you thinking about how you invest.
Hmm. Really understanding that is so important, and I think that's a underappreciated part of investing is understanding your psychological makeup and really knowing how you react to different headlines, how you react if the market's down 20%. I think people don't pay enough attention to that sort of thing.
Well, they don't, and part of it has to do with people in my industry. Okay, instead of listening to people and really trying to listen and ask them enough questions to know what makes them tick, they assume that my way is the right way, and we're going to put you into this deal, 60/40, whatever you want to call it, and if you'll just stay with it for 20 years, you're okay. That's not a good way to do it because everybody thinks about things differently, and you really have to get. We ask a lot of questions of people that have nothing to do with the market necessarily,
Mm-hmm.
but we want to know what makes them go.
Mm-hmm.
And once you figure that out, then you know which direction you want to get into. Because if you get that wrong with an investor, whether it's a super high or a super low, they're going to be unhappy. Okay, now, maybe unhappy because you weren't aggressive enough, because you didn't understand them, or they're going to be unhappy because it was overly aggressive and they're not that way at all. So you have people have to really get that part right, and our industry doesn't do a good job of it, by the way. Well, the problem, Vlad, is they're all canned approaches. In other words, I'm going to ask you 20 questions, and those 20 questions will tell me who you are. Okay. Well, would you marry somebody like that? Probably not. And so it's just similar in our business.
I wanted to ask you also that taking into account the importance of diversification, and you talk about this in the book, what would you recommend as the maximum that someone should hold in one specific investment?
Well, Vlad, I've always used about 25%, and I'll tell you why. I've had people that have 50%, 60, 70%, and sometimes it worked out even better. It really, really did well. But more than not, though, after going through a cycle, they have too much. Um, and so I always say, look, just try to keep it around that if you can. And I know that's the goose that laid the golden egg. I understand that. Okay. But do you really want to bet more than 25% of your net worth on one item? I would think not. And that's the way we look at it.
Mhm. That's great advice. And you had this update from the Oxbow Advisors YouTube page a few weeks ago where you had quite a cautious market outlook, I would say. So you talked about a few things. You talked about consumers being squeezed and that these days more people are having their utilities cut off due to missed payments. And then you also mentioned that credit card delinquency rates are rising. What are your thoughts on the markets for the next 12 months? And what are some of the things that you're doing in terms of client portfolio changes in order to prepare for that?
Well, let me give you an example. Today, the GDP number came out, and it was most people would look at it and say, it's the highest it had been since 21. If you look at the numbers on it, though, if you just look internally, you'll see the number one thing was consumer spending. Okay, how did that come about? They reduced savings and they increased their credit card exposure. That's how they consumed. That can't go on a long time. Okay. The other thing that got bumped up was this, one of this bill that got passed earlier in the year that spending was still going on with government, business, and other things. Nothing. You didn't get much out of it. And so our look right now for people is very conservative and has been really for 2 years. I mean, really, since the end of 21, January 22, we've been carrying high. When I say cash, it's short-term treasuries. And if you look at across the board for us right now, we're probably on average probably close to 60% in treasuries. Not because we think we're trying to time everything, but things were too expensive, and they're still too expensive relative to what they're making. And what's been happening, and we thought this would happen, is you get these bumps up in the market that would happen between, say, April and July, and everybody's like, "Well, it's a new bull market." Well, it's not a new bull market. We're still in a cycle. We're we're still well below where we were January 1 of 22 in every index. Okay, and so for them to think that we're back in a cycle, I don't want to understand where they're coming from. So we think we're just headed into what are going to be 2.5 to 3 quarters of really tough market. In other words, I've said all along this year in July, I kept saying that I thought the market peaked then, especially the big magnificent seven stocks. And sure enough, they have. And now they're starting to show earnings poorer. They're starting to roll over in price, but everybody owns them, Vlad. Everybody.
Mm,
And
mhm,
so if
mhm.
you want to see where the damage is going to come, it's in those stocks. And that's where we think people have made a lot of money in them. It's the same old story though. They won't sell them. I look at Apple as probably the most overowned stock I've seen since I've been in this business, and I've been in it a long time.
Oh, wow.
Individuals, institutions, everybody, every mutual fund, it doesn't make what difference they are. They all have Apple. Okay. So somewhere along the line, those stocks will start to suffer. And so but I think the next 3 quarters is going to be tough. And for us, maybe that's not right, but for us and our clients, it's preservation of capital first. So that's why we're making over 5% on all the treasuries. So it's not like you're not making any money. So that's a good thing for us.
Oh, that makes a lot of sense. And I wanted to ask you in the book, you talked about three asset classes primarily. So it was cash and cash equivalents. You talked about bonds or fixed income and equities. What are your thoughts on alternative asset classes? I was at this conference a couple of months ago, and it seems like everybody who I talked to wanted to talk about alternatives. But just wanted to hear your take on it, since you have so much experience in the industry and you can really separate, the fluff from what is actually going on.
Vlad, it's a fad. I will tell you, in my opinion, by the way. But if you look at alternative investments in private equity, private real estate, really, they're in the old days we call them. They were just leveraged buyout companies. Still are. They're still the same thing. Wall Street decided they were going to change the name on it and do it differently. But when you go in and look at those companies, they're highly leveraged, okay? And every time I meet a young person, 28-year-old MBA, I ask them a question, what are you doing? Well, I'm working for a private equity company. My first question to them is, have you sold any companies this year? No. Why? Well, we're just trying to get them into mature stage. Well, you know what really is happening? They're not good enough to sell, all right? And Wall Street will dream up every way they possibly can to take your money. Promise you. I've been in this business, since the mid '70s. I can give you every fleece job known to mankind. And they just finished three or four big ones, by the way. SPACs, unicorns, all that kind of stuff, and private equity, by the way, and the alternatives. So these pension plans that all have 30%, 35% alternatives have no idea what they have. You know what they get? They get a valuation written on a piece of paper that said somebody made a valuation. How does real estate and private equity do well this year when real estate's falling apart all over the country? You see? But it's Wall
Hmm.
Street,
Hmm.
and it's all of that stuff's unregulated, and it's set up that way. Everybody's in bed. So, you have to watch out for yourself. But for people that want to own, I see these family offices that want to own, I'm in touch with a lot of them. They want to own 30, 35% alternatives. And I always ask them the question, how do you know what's going on here? You see there's lots of fees, in, out fees, management fees, overlook fees, and so Wall Street will do whatever they need to do to take as much money as they can from you and use it for their benefit, by the way. And you'll find me to be a big cynic because I've seen it over the years. I could give you every starting back in the late '70s, computer leasing. Then they did drilling rigs. Then they done everything. And so I don't have a. I think people need to be careful about alternative investments. And if you're going to do them, go out and buy yourself your own building. You don't. Why do you need to go through somebody fourth party that you don't even know where the building is? You don't know who runs. You don't know anything. Okay, own your own real estate. Own your own oil and gas royalty.
Hmm.
Own your own private business with somebody that you really know is a good business person.
Hmm.
And forget about the Wall Street stuff. Is that a blanket statement? No. Some of them are going to do okay, but usually the people who do okay, just mark my word, are the people running the place. They're the ones you see out in the Hamptons, by the way. So people need to keep that in mind if they're trying to hold on to their money. And I feel sorry for so many pension plans and foundations today because they've had consultants sell them on this stuff, but they don't really know what they have. And while right now they could get 5% or 5.5% in a treasury, I mean, see, it doesn't make any sense. But hey, that's the way life is.
Yeah, I totally agree with you on a lot of the points that you mentioned.
Well, they're unregulated, and they're trying to start maybe regulating a little bit, but that whole group, that whole business is unregulated. So, they don't play by the rules, and people need to understand it. But they make a lot of money at it, and that's just the way it goes. If you go read, there's a couple of great books out. One by Gretchen Mortensen, who's done a lot of writing for in New York. She writes about the plundering private equity companies, and there's another book called The Plunders. I mean, there's two great books out right now that'll show you exactly what goes on in those businesses. And I'm not saying they're all bad, but I am saying that you need to be really careful about putting a lot of money in that category.
Mhm, mhm. And Ted, one of the things that you mentioned in the book that I really enjoyed was you mentioned that investors often ask if certain strategies can beat the market. and you consider that to be the wrong question to ask. Can you tell us why is that the wrong question to ask, and what is the right question that investors should be asking their advisors?
Well, I think what happens is people have this idea that you really can always beat the market, which you can't. And in addition, what's beating the market? If the market's down 50% and you're down 40, you feel good about that? I mean, there's all kinds of things to look at here with that. And what I think people should do is think about this. Okay, for me, okay, what do I need to do to, number one, stay up inflation, keep my buying power intact? Okay, because that's all investing is you've got to maintain buying power over many years. Keep that intact. Keep cash flow where I need it for myself going forward. What can I do that matches up with what I need the next 10 years? What is that? Okay. And that's not necessarily, I need to beat the stock market. Okay. That's why I say that so many of these really wealthy families that inherit all this money that should be multi billionaires today, all they had to do was do something in the middle. Not They didn't have to go high end or anything like that. Just had to do a nominal return, and they'd had billions today. But they didn't do it. They get out and try to beat the market, which you're not going to do. But you can over time. You can for periods. But the problem is, I think you have to design whatever you're doing for you, because if I'm making more than the market is in certain years, and that's a great strategy. And I've seen fund managers do this, and people jump in the middle with them, and then all of a sudden things go the other way, and they get in just in time to go down, go down, and then see they're not thinking about what they need. They're just thinking about chasing something else.
Yeah, it's so important to understand somebody's individual specific goals that they want to accomplish relative to their money, and to basically structure everything in their investment life accordingly. It's not necessarily about, for some people, it's not about getting the highest return. For some people, it's just being able to sleep at night and not worrying about their portfolio. That for them is the number one thing that they want.
Yeah, goes back to those questions I've talked about. You have to know who you're talking to.
100%. Ted, thank you so much for joining us. I really enjoyed your latest book, and I wanted to ask, where can our listeners get a copy of it, and where can they go to hear more from you?
Well, the best place for that, if they just go, we're obviously on YouTube and Twitter and different places, but the best place really is to go to oxbowadvisors.com, and we'll send you a free copy of any of those books you want. Those books are designed for you to read, as you know, in about 2 hours, 2.5 hours. So we want to get the point across. We're not trying to hold ourselves out as some fabulous author, but we are trying to get some points across. And so that's one. And in fact, in about a month or 2 months, I have a rewrite of a book I did years ago. I wrote a book called 20 Million and Broke, and this one's now called 30 Million and Broke with inflation. Yeah, but anyway, go to the website, oxbowadvisors.com. You can see about anything you want there.
And we're going to have all of your resources to your website and the Twitter and the YouTube page in the show notes. So our audience definitely should check it out. Ted, once again, thank you so much for joining us today.
You bet, Glenn. Good to visit with you.